Number 2, profit and loss. And firstly, what is a profit and a loss account? So the profit and loss account, known as the P&L, is a financial report that shows the revenue, expenses, and profit or loss of your company over a specific accounting period. The period can be a month, a quarter, or a year. And a P&L is also commonly referred to by other terms, such as the income statement, statement of operations, financial results statement, and earnings statement. Profit and loss statement, the P&L, which is also called the income statement, is a company's financial statement that indicates how the revenue, which money received from the sale of products and services before expenses are taken out, also known as the top line, is transformed into the net income, which is the result after all revenues and expenses have been accounted for, also known as the bottom line. The purpose of the profit and loss or income statement is to show managers and investors whether the company made or lost money during the period being reported. The important thing to remember about an income statement is that it represents a period of time. This contrasts with the balance sheet, which represents a single moment in time. So then, why is a profit and loss account important? So the profit and loss is a key financial statement in a business plan, as it quickly shows how much money your business has made or lost. What's important is to compare your profit and loss across different accounting periods. In doing so, you'll be able to identify business cycles and trends, such as the peak and trough periods that occur across the year. So think of it like this. Or aspects of your business that generate the most profit or costs. You may also identify changes that are not immediately apparent, such as periods where your expenses are growing at a faster rate compared to your revenue. With these insights, you'll be better positioned to make improved business and financial decisions. And lastly, information from your P&L can also be used to calculate metrics that are important indicators of your company's financial health. These include the operating ratio, gross profit margin, and net profit margin. And we will come to all of these in more detail shortly, so stay tuned. Okay, so let's now have a look at the income statement, formula, and calculation. So net income equals revenue minus expenses. Let's break this down. So number 1, total all revenue or sales for the period. Number 2, total all expenses and costs of operating the business. Number 3, subtract total expenses from revenue to achieve net income or the profit for the period. Alright, so you know the profit or net income equation. Now we can have a look at the key elements that make up the profit and loss. So number 1, sales or revenue. And this is the amount that your company earns through the sale of goods and services. Number 2, the cost of goods sold, COGS. And this is the total amount of all costs involved in selling a product during a specified period of time. Number 3, gross profit, which is also known as the gross margin and refers to a business's profit before the operating expenses, taxes, and interest payments are taken into account. It is also calculated by deducting the cost of goods sold, the COGS, from the total sales or revenue. Number 4, operating expenses. And this refers to the expenditure that a company incurs in performing business operations that aren't directly related to the production of goods or services. Some examples include salaries, utility payments, administrative expenses, and rent. And number 5, net profit or loss. And this is the net profit or loss which is obtained by deducting the total expenses from the gross profit. And please also note that turnover is income or revenue that a company receives from its normal business activities, usually from the sale of goods and services to customers. Number 3, balance sheet. For business owners and contractors, staying on top of your business finances and documents can be daunting. A balance sheet provides a snapshot of the financial condition of a company, showing how much it owns, its assets, and owes, its liabilities, and the amount that is left over for its owners, which is called owner's equity, at a specific point in time. The equation for this is shown on the screen as assets equals liabilities plus owner's equity. Or the equation could also be assets minus liability equals equity. The balance sheet is typically completed at the end of a month or financial year, It is divided into two sections. The left side shows the assets of the company, while the right side shows the liabilities and owners or shareholders' equity. So, in summary, the balance sheet comprises of three main elements: assets, liabilities, and owners or shareholders' equity. The total sum of all assets, less a business's total liabilities, is equivalent to the owner's equity. This represents the amount that would be available for a business owner to draw out. Of the four basic financial statements, the balance sheet is the only statement which applies to a single point in time. The balance sheet is very important, and let us see why. The balance sheet lets a business owner and investors see what the company owns and owes, and to understand its net worth. It also indicates the financial health of a business. For example, a balance sheet that shows a negative balance in owner's equity indicates that liabilities exceed assets. This can be a warning sign that the company is in a bad financial situation and should prompt business owners to dive deeper and uncover the causes for the negative balance. A balance sheet can also be used to calculate important financial ratios. One example would be the working capital ratio, which is obtained by dividing the current assets by current liabilities. This ratio measures a business's efficiency and shows how well it is able to meet its short-term obligations. And for business owners seeking external financing, the balance sheet, along with financial statements like your cash flow and P&L, are required documents when you apply for a loan from the bank. All right, so now we know about the profit and loss and the balance sheet individually. Let's compare the two together and review profits and loss versus balance sheets. Although the balance sheet and the P&L statement contain some of the same financial information, including revenues, expenses, and profits, there are important differences between them. And here's the main one. The balance sheet reports the assets, liabilities, and shareholders' equity at a specific point in time, while the P&L statement summarizes a company's revenue, costs, and expenses during a specific period of time. In terms of the purpose of each statement, each document is built for a slightly different purpose. Balance sheets are built more broadly, revealing what the company owns and owes, as well as any long-term investments. Unlike an income statement, the full value of long-term investments or debt appear on the balance sheet. And the name balance sheet is derived from the way that the three major accounts eventually balance out and equal each other. All the assets are listed in one section, and their sum must equal the sum of all liabilities and the shareholder equity. The P&L statement answers a very specific question. Is the company profitable? While accountants use the P&L statement to help gauge the accuracy of financial transactions, and investors use the P&L statement to judge a company's health, the company itself can review its own statement for productive purposes. Closely monitoring financial statements highlights where revenue is strong and where expenses are incurred efficiently. And the opposite is true as well. For example, a company might notice increasing sales but decreasing profits and search for new solutions to reduce costs of operation. In terms of profit versus total value, the P&L statement shows net income, meaning whether or not a company is in the red or black. And the balance sheet shows how much a company is actually worth, meaning its total value. Though both of these are little oversimplified, this is often how the P&L statement and the balance sheet tend to be interpreted by investors and lenders. It's important to note that investors should be careful to not confuse earnings and profit with cash flow. It's possible for a firm to operate profitably without generating cash flow, or to generate cash flow without producing profits. Let's now have a look at how the statements are calculated. The P&L statement requires accountants to add up to the company's revenue on one portion and add up all of its expenses on another. And the total amount of expenses are subtracted from the total revenue, resulting in a profit or a loss. The balance sheet has a few different calculations that are all performed as representations of one basic formula. Assets equals liabilities plus owner's equity. Okay, and so in summary, When used together along with other financial documents, the balance sheet and the P&L statement can be used to assess the operational efficiency, year-to-year consistency, and organizational direction of a company. For this reason, the numbers reported in each document are scrutinized by investors and the company's executives. While the presentation of these statements varies slightly from industry to industry, large discrepancies between the annual treatment of either document are often considered a red flag. A firm's ability or inability to generate earnings consistently over a time is a major driver of stock prices and bond valuations. For this reason, every investor should be curious about all the financial statements, including the P&L statement and the balance sheet of any company of interest. Once reviewed as a group, these financial statements should then be compared with those of other companies in the industry to obtain performance benchmarks and understand any potential market-wide trends.